Hey, it's Rav. Welcome to the Everyday Investor TV show, the show that teaches you how to grow our money, your money, my money. God blesses us with a job, but imagine a life where you could work a little less and money could make you money to be able to spend it, your time with family, friends, engage in a purpose that's greater than yourself. That is what the Everyday Investor TV show is all about. Every week, I bring in an expert in their field, a different investment strategy, so that we both can learn. Don't go anywhere. We'll be right back. Coming up, we're talking to Darren Mitchell, and he's teaching us how we can make money investing in the infinite banking concept.
If you're a business owner or an investor and you buy something for $1, in this case the use of that $100, and you sell it for $10, how much profit do you make? You make $9 on a $1 investment.
Did you know that if you're selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, zero commission. Head over to our website, everydayinvestor.com, and find out more.
Do you love private lending, but are starting to feel like the passive side of it isn't as passive as it once was? Is running for bank drafts, wires, and constantly picking new deals taking the passiveness out of your passive investment? The CapCap Mortgage Trust has a lending solution for you. In our fund model, we allow you to invest across a pool of diversified mortgages, generating stable returns in a set it and forget it model. If this is the type of solution you have been looking for your private lending, make sure to reach out to myself and the CapCap team so we can help you.
Hey, it's Rav. A few years ago, I learned how to trade stock options by taking the Theta trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I'm not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more.
Hi, welcome back to Everyday Investor. I am not Rav Toor, I am Darren Mitchell. And similar haircut, so you might, like the resemblance. But Rav's asked me to spend some time really teaching the viewers about infinite banking. But for this first part, I thought I'd step back and really talk about traditional financial planning and why traditional financial planning has failed the real estate investor, the business owner, and the passive investment person. Okay? If you're a passive investor, business owner, real estate investor, the cookie cutter approach to saving and investing is not the right fit for you. And we're going to go through that. And I want to start by an example. I'm going to give you an example, and I'm going to say, let's say you're sitting at work tomorrow and some guy comes in off the street and he goes, hey, my name's JT. He goes, I think we should go into business together. It'll be a pretty weird, guy off the street, but let's just play that out. If someone came into your office tomorrow and they gave you this business proposition, what would you say? So the guy comes in and he goes, Darren, I want to start a business with you. Here are the rules. Number 1, you have to put up all the money. All right, so this guy wants you to put up all the money. Okay. And he goes, I want you to take all the risk. So I got to put up the money, I got to take all the risk. Yep. What else? Oh, when it comes to fees, he wants me to pay all the fees. So you put up the money, you pay all the fees, you take all the risk, okay? What about control? No, you have no control. You totally give up control of this money. You totally give up control of this money, and you can't use it for those business opportunities and real estate opportunities, passive investment opportunities that come along. Now here's the 5th one. This is the kicker. So after this guy comes in and says, yeah, this is a great business. You give up all of the, you put up all the money, you take all the risk, you pay the fees, you give up control. Number 5, ownership. The guy says, let's just leave that vague. Tell you what, in 30, 40 years, I'll let you know how much of the business is yours and how much of the business is mine. If a guy came in your office and suggested that business proposal, would anyone watching today actually do that? Well, what I described is an RRSP, and those are the rules for an RRSP. You put up all the money, you take all the risk, you pay all the fees, you give up control so you can't take advantage of other opportunities, and the ownership is vague. What do I mean by that? If you have $1 million in your RRSPs, roughly half is going to go to the federal government in the form of taxes, and half's going to go to you or your family. And what happens if taxes go up? Anyone think taxes may go up in the next 10, 20, 30, 40 years, the way governments are spending money? That's them changing the ownership. So all of a sudden, last tax rate was up 4%. They basically said to the top tax bracket, we want another 4% of this business we started together where you put up all the money and took all the risk and paid all the fees and had no control. That's how an RRSP works. That doesn't make sense for a business owner or a real estate investor. They need to do things differently. So let's stay with the RRSP theme for a second and let's kind of bust some myths of the RRSP. Number one, RRSPs are a tax deduction. That's a myth. They're not a tax deduction. They're a tax deferral. You're deferring the tax and you're deferring the tax calculation. Okay? So let's put some numbers to it. If I take $100 of my last $100 of income and I'm in a 30% tax bracket, well, if I don't put that money in the RRSP, I'm going to pay 30% tax. So I'm going to be left with $70. But if I put that money in an RRSP, I'm going to have the full 100. So let's fast forward, say 10 years at 7%, okay? Just roughly that's how long your money would take to double. Your RRSP is going to be worth $200. Your $70 in your TFSA or infinite banking is worth $140. So in the surface, you go, all right, well, 200 is more than 140. I don't understand why this RRSP thing's bad. Well, okay, your money was in jail, you couldn't take advantage of opportunities and emergencies, but forget about that. What happens when you go to take this $200 out of your RRSP? You pay tax. Let's assume you're still in a 30% tax bracket. At 30% tax, you're going to net $140. The exact same as your tax-free savings account, your $140 there, no tax payable on it. So you're no better off or no worse off. Now you've locked up your money for that time, but you're no better off and you're no worse off. People don't think like that. You know who definitely doesn't agree with that? Wealthy people. Wealthy people are not willing to give up control of their money for a tax deferral. Okay? What else about RRSPs? I find when people save for RRSPs, they save for a number. You ever see those bank commercials? Guys got like 1.2 million or 1.3 million or 800,000. What's your number? How much do you need to retire? Well, guess what? The only question that matters when people come to talk to me in retirement, they don't say, what's my number? They ask one question. How much money can I spend and not have it run out in my lifetime? It's not how much your number is, it's how much you can spend. And oftentimes, if you're properly structured, you can have less money, but you can effectively spend way more than you could in the traditional financial planning if you can come up with tax-free strategies and ways to guarantee your money doesn't run out. So it's not about the number, it's about the income that number can produce. All right, now when we talk about RRSPs, we talk about money in general. I'm going to get this really down simple. There's only two things you can do with your money. Let me start a fresh page. If you have some money, there's two things you can do with that money. You can spend it, or you can give it away. That's really it. Well, what about saving? Yeah, well, you can save it for a while, but eventually what needs to happen? You need to spend it, or you need to give it away. You can give it away in your lifetime, or your will can give it away at death. But either way, those are the only two outcomes with your money long term. Spend it or give it away. So let's talk about an RRSP. If you spend it, did anyone ever tell you, did your financial advisor ever tell you, if you have $1 million in your RRSP, how much can you spend? Well, the safe distribution rate, if you just Google safe distribution rate, is somewhere around 4%. Some people argue 3. Let's just assume 4 for this. And what that is all these math geeks go through 1,000 different simulations. They call it a Monte Carlo simulation, and they go, all right, based upon history of the markets and interest rate, what percent of your money can you take out and have it last your lifetime? So it's roughly 4%. If you really want to geek out on this, Google Dr. Wade Pfau, P-H-A-U. He's written some great papers on retirement income. So if we spend it and we have $1 million and we can only spend 4% a year, that's $40,000. Now that doesn't sound like a lot of money, does it? $1 million, worked your whole life, saved that money, and now you're gonna get $40,000 a year for the rest of your life in retirement? Okay. Now, what if we give it away? Oh, let's stick to the spend it here. Any chance you might be making more money down the road than you're making now? So let's just say you're making 100 grand now, you're 35 years old, and you're making 100 grand salary. Let's assume a 4% raise a year, 3-4%, doesn't really matter. If you get a 4% raise every year on a $100,000 salary and you go, you know what, Darren, I could retire today, I want to make it. 100 grand, I could live on that. Okay. Well, in 30 years, that 100 grand at a 4% salary increase is going to be $325,000. So you would need to make $325,000 in 30 years to live as you live today on 100,000. So in 30 years, 325, same lifestyle as 100 today. So using our safe distribution of 4%, how much money would you have to save to produce an income of $325,000 a year in retirement, which is just maintaining your 100,000 in today's standards? Well, it's about 8 million. 8 million times 4% is roughly 325,000. So do you think you're going to save $8 million in your RSP? Probably not. You got to look at different strategies. Now the last part of the RSP, what happens if you give it away? So what happens if you take that $1 million and you say, I'm going to leave that to my family? Now I had an individual come into my office one time, or a Zoom call, and he said, okay, I have $1 million in my RSP. I'm going to leave it to my 4 kids, 250 grand each. And I had to break the news to him. I'm like, okay, what happens to your RSP when you die? If you have a spouse, it transfers tax-free. If you don't have a spouse and you want to leave it to your kids, it is fully taxable in the year you die. So if you make 100 grand in the year you die and you have $1 million in your RSP and you don't have a spouse, your terminal tax return is going to show an income of $1.1 million. So depending what province you're in, you could pay 53, 54% tax. So this guy was in a 54% tax bracket at death, because he's going to have to throw another $1 million on top of his income. 54, where we got? We got $1 million, 540,000 would go to CRA, and the remaining 460 grand would go to his kids. He had 4 kids. Each kid was getting 115,000 after tax. CRA was getting 540,000. Is that how you want to divide up your estate? From all that hard money, or all that hard work you did in your lifetime and grew your wealth, to give 54% of it to the government at death? It's not what the wealthy do. They come up with better solutions. In the next part, I'm going to share more.
Did you know that if you're selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, 0 commission. Head over to our website, everydayinvestor.com, and find out more.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hi, it's Darren Mitchell from Control and Compound. Welcome back to the Everyday Investors Show. Again, I'm not Rav. I'm filling in for Rav today to help educate people on the infinite banking concept. But in this episode, we're going to dig into more traditional financial planning and why it doesn't fit for real estate investors, business owners, and passive investment investors. All right, so let's stick with the theme of what traditional financial planning is and why maybe the wealthy and the business owner, the real estate investor aren't looking to those cookie cutter models. Let's talk about the stock market. And people are always talking to me, oh, Darren, you don't like the stock market. And I'm like, I'm fine with the stock market, okay? If you get some money long term. But if you're a business owner, real estate investor, the stock market is not where you can put money that you're going to use in the next 0 to 5, 6 years. If an opportunity comes along when the stock market is down 40%, that's really when all the opportunities come, you're not going to cash that out and lose 40%. So you've got to be in a place that's not going to follow the stock market. And I'll show you another sort of game they play in the stock market. I want you to go to your financial statements you have in your RSPs, your investments, and I want you to find the actual rate of return versus the average rate of return. Let me show you what I mean. Here's the stock market. Some messy stock market. Let's talk about the stock market. Let's talk about average returns. So how do we get the average of something, right? Well, usually, sometimes we just know intuitively. If you took the number 6 and 8, what's the average of 6 and 8? Well, we know the average is 7, but how did we actually get that? Well, we added 6 plus 8 equals 14, divided by 2 equals 7. So we add up the numbers and we divide by the amount of numbers we put in, okay? Congratulations, you're up to grade 3 math now, okay? Well, what does that have to do with the stock market? Well, let's use actual numbers and say, what would the average return be in this scenario? So I want to look at 4 years. So year 1, you do plus 100%. Okay, you get an advisor that's a rock star, man. This guy, plus 100% in your portfolio. Pretty cool. Year 2, you lose 50%. All right, not great, but still, you're up 100 last year. Year 3, another phenomenal year, plus 100. But then, it's taking some risk. Year 4 was tough again, you're down 50%. Awesome. So, now your financial advisor meets with you after 4 years and he goes, listen, Mr. or Mrs. Client, I don't want to toot my own horn, but I'm a bit of a guru. Because if we add these numbers together, we've got plus 100, minus 50, plus 100, minus 50. That adds up to 100. And we divide by 4 inputs. That's a 25% average return. Now, if your advisor told you you're getting an average 25% return, I'd be pretty impressed, wouldn't you? But did you ever notice on your statements sometime you're like, I don't feel like I'm getting ahead that much. I feel like I'm almost just growing by what I contribute every year. Well, let me tell you about a little secret called actual rate of return. Spoiler alert, it's only the actual that matters. So let's use those same numbers. Let's look at the actual rate of return. Year 1, you start with $100,000, let's say. And you go plus 100% year 1. How much money do you have? 200,000. 100, it doubled. Okay? Year 2, we had that minus 50. Well, if you have 200 and you lose half, you're down to 100. Year 3, you doubled your money, plus 100, you're back to 200. And year 4, you lost half again, you're down to 100. So your actual rate of return is 0, but your average rate of return is 25%. Which one do you care about? I couldn't care less about the average return. I want to know what my actual return is. So when you see these average rates of returns, okay, again, always think just just in the back of your mind, if there's something missing, there might be something missing. So that's the average versus the actual. Now the next thing I want to do is I really want to dig into how banks make money. Now I wrote an Amazon best-selling book called Be the Bank, and it's on Amazon if you want to check it out, and it covers a lot what we're talking about. But let's dig into that next. Let me just clean the screen here. So when we talk about banks, banks really, make a lot of money. We all see the bank earnings every year. Well, how do banks make money? And why do wealthy people try to act like a bank? Okay? Well, let's talk about a bank. Banks have 3 wants. The banks want your money systematically. Okay? They want to hold on to your money as long as they can. And when they pay it back to you, they want to drip it back as slow as possible. Okay? So those are the kind of banks' wants. Now, in practice, how does that look? Well, let's see. Your paycheck's deposited in the bank every 2 weeks. 20 years old, they tell you should start an RRSP at the bank. They sell you an RRSP from the bank. You put that money in an RRSP. It stays in your RRSP at the bank for the next 50 years until you're 70. And then they go, okay, now at 71, we're going to turn your RRSP into a RIF. All right, they turn it into a RIF, so they've held it for 50 years. They've controlled it for 50 years. Now it's time to say, great, now I start drawing an income from this. How are you going to draw an income? Oh, we're going to drip it back to you piece by piece. Maybe 4 or 5% a year we'll pay out to you, and we'll hang on to the rest. The bank has been in control of your money in that situation for up to 80 years. The entire time, someone else was in control of your money. Wealthy people don't go for that. Banks also have 3 rules they follow. So rule number 1 at a bank, they want velocity of money. What does velocity of money mean? Velocity of money means a bank keeps money in motion. When you go in there with a $100 deposit, you get a $100 bill. Do you think that bank takes that $100 bill, turns around, walks back to the vault, spins the wheel, gets in there, finds the pile in the corner that has your name on it, and adds another $100 to it? Absolutely not. The bank is looking to get that money out the door as fast as possible. So they want velocity of money. Because I'll tell you a little secret. Money works just like blood and water. If it's stagnant, it dies. Blood needs to flow, water needs to flow, money needs to flow. All right, what other rules? Number 2, they're all about cash flow. Banks want to make sure they have cash flow. And number 3, banks, for them, it's very important to use leverage, right? What's leverage? Just like real estate, okay? They're gonna loan out that money several times, not just one time. So those are the 3 wants, those are the 3 rules. But how do they actually make money? So I'm going to sum up why we want to be a bank here with an actual example, and we're going to use Ross and Rachel for this example. So we got one person that wants to put money in, and one person in the bank, and one person that wants to borrow it. So let's play that out. So here's your bank, okay? Beautiful drawing, I know. And we're going to take Ross. Ross has $100. And Ross deposits the money in the bank. And the bank says, Ross, thanks for that. We're going to pay you an interest rate when you put money in the bank. Now, is it usually a big interest rate you get at a bank? I find it's usually next to nothing, and by the time I pay fees, I'm actually going down every month. But let's just play this out and say they give Ross a 1% interest on his deposit. So he puts $100 in, and they pay him 1%. Now, what does the bank do with that money? Well, the bank is in the lending game, so they want to loan money out. So who are they going to loan it to? Well, the bank could loan it at 6%, maybe on a mortgage, or maybe 10% on a line of credit, maybe 15% on a second mortgage, or maybe 12% car loan, 10% some other type of loan. There's all kinds of options, right? Credit card, 28%. So let's just say the bank, we'll keep my math simple here. Let's say someone came into the bank, let's call her Rachel. So Rachel comes in, and Rachel says, I want to borrow $100. So Rachel borrows $100. And the bank, they're good at lending money, and they say, all right, Rachel, you know, you're a waitress, you don't have a lot of assets, but we're going to loan you $100. Let's just use 10%. So they're going to charge her 10%. Now, here's the million-dollar question. How much did the bank make? Well, let's do the math. They made 10%, they charged Rachel 10%, and they paid Ross 1%. We know math. 10% minus 1% is a 9% return. So that's a pretty impressive return, but it's not like knock your socks off. Like, why are these wealthy people, why are millions of Canadians trying this infinite banking, learning how to be like a bank? That 9%, I mean, it's good, but let's put some numbers to this. Is it really 9%? Let's put some dollar numbers to it. Ross put $100 in the bank. What did the bank pay him? 1%. What's 1% of $100? $1. They paid Ross $1. Why did they pay Ross $1? They paid him $1 for the use of his money for a 12-month period, 1% per year. So they said, Ross, thanks for the use of that money for a year. And what did they charge Rachel? 10% of 100, or $10. Now, if you're a business owner or an investor, and you buy something for $1, in this case, the use of that $100, and you sell it for $10, how much profit do you make? You make $9 on a $1 investment. That's a 900% return. The bank made 900% in that case. But here's the thing. The bank just didn't loan the money to Rachel. All these different things here, the bank loaned it at a 6% mortgage, and the bank loaned it at 10%, and the bank loaned it at 15% for a second mortgage, and 12, and 10, and the 28% credit card. The bank multiplies their money. They leverage their money and they loan it over and over and over again. So now you take that 900% and you multiply it by the amount of times the bank has loaned it out. Now we see why banks are some of the most profitable businesses in the world and how they make money. We also see why you want to be like a bank. If we can do the same concept in our personal financial planning to put money in, grow it, save it tax-free, and use it for opportunities without giving up the growth of that investment, that's what wealthy people do, that's what infinite bankers do, and that's what we do at Control and Compound. We're experts at this. Business owners, real estate investors. We're going to spend the whole next episode going through why infinite banking makes sense for you. But I thought it was important to start this exercise, education exercise of why traditional financial planning might not be a fit for business owners and real estate investors. We're going to show you what is a perfect fit and what millions of Canadians are using already. Thanks for watching. We appreciate it. Everyday Investor will be back again.
And thank you guys for watching. Without you, we would not have a show. If you want to see this show again or you want to see any of our other shows, make sure you go to everydayinvestor.com. You can watch them there. Click on episodes. It's like watching on demand. Make sure you also sign up to receive the episodes right into your inbox. Look forward to seeing you next week. Same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.